Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. First up, I want to wish all our viewers a very, very happy Diwali to you, your loved ones, your workplace, and everyone around you. It's a time of festivity. So, from all of us here at CNBC-TV18, wishing you health, prosperity, wealth, and of course clarity in this new Samvat 2082. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning and happy Diwali.
Happy Diwali, Prashant. Happy Diwali, Nigel. I was away for the last couple of days, but I'm so glad I could be back in time to celebrate the festival with Team CNBC TV18, because that's when you truly feel festive. And a big, happy Diwali, health, wealth, prosperity, peace of mind. Wishing all of that and more to our viewers as well. Good morning, Nigel.
Well, that's right. Good morning. Welcome back, Surabhi, and happy Diwali, guys, to both of you, your families as well, and all our viewers out there. And luckily, we've had a good rally getting into this Diwali season. So it feels like Diwali, not not the year we had, but the run-up actually has been pretty good.
Absolutely. Actually, it didn't feel like Diwali till about 3 weeks back.
True.
Yeah.
And then, the market started moving last 2 weeks or so, 2.5 weeks or so.
Yeah.
So let's take it from there, right? As we
and decent earnings, right? Decent earnings.
Yeah.
That huge deluge of FII outflows, that's reduced. We've got some positive days as well. Earnings are looking good. The index is climbing higher. Feeling good?
Feeling good. It's a feel-good day. So good to have you back.
Good to be back.
Tomorrow, of course, is Muhurat.
Yes.
So 1 hour in the afternoon, not evening
Not in the
like we
evening.
always do.
Yeah.
Prashant's got a plan tonight.
Actually, it's my wife's birthday today. So,
Okay.
A very, very happy
birthday to
birthday to ma'am. And there's something special happening this evening. A gift. Let's get to it.
Anyway, let's just take it from the top in terms of what you need to know as we begin this new trading session. New trading week, it's a holiday shortened one. Today, of course, we trade for the full session. Tomorrow is 1 hour Muhurat session. And then, of course, Wednesday is a market holiday, Thursday, Friday. So in that sense, and many people, of course, will be for Diwali, etc., out with families. So perhaps participation, etc., a little lower than usual. But that shouldn't deter the market per se, which has been on a tear, right? And I think the graphics will come up. Last 2 weeks is basically where all of this has happened. So the Nifty is up about 1,200 points in the last 2 weeks. That's about 5% move. The Bank Nifty is up 3,600 points. That's about 7%. And the mid-cap index is up about 5.5%. That's about 3,100 points. So just 2 weeks. Of course, these levels are from the lows 2 weeks back to the highs that we saw last week, which is pretty much where all these indices left off on Friday. That is last Friday. Now, not very much has changed over the weekend as we come back into this new week. Some of the broader core themes remain the same. NASDAQ, after all said and done, and by the way, last week, there were these credit concerns which were flying off here and there. 2 banks had reported hits to that they were hit by frauds. And for a moment there, it looked like we perhaps will have a repeat of what Silicon Valley Bank, that entire episode. But, Friday session, again, lots of regional bank shares closed higher. For the week, NASDAQ was up 2.5%. S&P ended higher. So that piece remains quite okay. Gold continues to make new highs, so about $30 off the all-time highs. $4,250 an ounce is where gold prices finally sort of ended. And so, these are themes. These are essentially debates which continue. It's not one way or the other. It's not the debate is around whether the gold has done too much, and that continues as we come into this week. The debate is whether this AI is especially the amount of capital which is going into AI stocks is a bubble. That continues as we come back into this week. But there's no real perceptible change in the direction of travel as far as some of these themes are concerned. Now, just in terms of news flow over the weekend, I'm not sure what to really make of it from an implication point of view, but mass demonstrations over the weekend. They're called No Kings protests held across the U.S. against the Trump administration. And of course, President Trump responding in a style that I guess only he could on Twitter, social media, etc. So lots of stuff around that, lots of coverage around that, really. Treasury Secretary Scott Bessent to meet Chinese officials, this week in a run-up to the president's meeting, which is supposed to be in early November. So there seems to be a little bit of a thaw. President Trump indicating that additional 100% tariffs on China perhaps are not sustainable in that sense. And just to sort of circle in the two sectors here, large cap IT, which has been such a large underperformer. Week before last was great for IT. Last week, once again, there was a bit of a drift off. But just look at the top 6 large cap IT companies which have reported earnings, and they're all largely in line or slightly ahead of expectations. But the bigger one, of course, is financials, right? I mean, the financials, the bank Nifty has been doing very well. Both on the fiscal and monetary side, it was all starting to build up. And of course, add and throw into to that entire mix the point that valuation seems to be a little comfortable. And I think you've got a kind of a good mix here. So banks, perhaps one area where there always has been consensus optimism, but I guess it didn't perform for a while. But I think it's coming back. And we'll talk more about this as we go on. I'll just tie in the levels here, and then we'll look at the F&O stuff. So Nifty's taken on most important resistance levels. So all-time high is 26,277, but before that, perhaps a stop at the psychological level of 26,000. So keep an eye. The trailing stop is basically the 40-hourly exponential average, which is 25,412, which has, of course, been dragged higher along with the market. Nifty Bank has made a new all-time high. It's taken out the prior high of 57,628. So you're basically in uncharted territory, and support here at 56,970, which is the 40-hourly for the Nifty Bank as well. GIFT Nifty will give you a quick sense of how we are starting, and then we'll, of course, look at the broader F&O setup. A lot of short covering, not a lot actually, but a fair bit of short covering, which, of course, has led to this massive move that we've seen, 5-7%, depending on what index you look at. Over the last 2 weeks or so. So it's a pretty good start. 1% higher, 220, 230 odd points higher is what the indicative open on the GIFT Nifty is looking like. So you're going to be closer to 26,000 if you go by the rate on your screens. But Nigel, the F&O stats, that short covering continues.
Well, that's right. And it seems the FIs actually have pivoted over the last few days, just going by the kind of action that we have seen. The FIs, they seem to be coming back. They're covering shorts. They're showing in the money as well. And today, the session is going to be quite interesting because I'll tell you what, we have the weekly expiry as well that will be playing out this time around on a Monday, because tomorrow, obviously, we do have the Motor trading session. But the FI flows, that's the one that I'm looking at. Last week, they gave you a bit of a heartbreak, and then they came back. So the last few trading sessions, the FI money has gradually started coming back. Remember, they have been underweight on the Indian markets if you compare to the MSCI Emerging Market Index, or you just look at the flows on the whole. So good to have them back. Hopefully, they celebrate Diwali with us and even into Christmas with regard to those flows. Moving to, the short covering bounce that we are talking about. It seems the bulls went ahead and they squeezed those shorts with a big hug. Because in Friday's trading session, just take a look at that. It was evident that there was a short covering bounce that was playing out. And the data points coming in from the FIs will perfectly tell you that. So the FI data point should come up for you on the screen. Just take a look at it. The short positioning down by close to around 50,000 contracts. And just take a look at the Nifty. Well, the Nifty has seen a good run in the last few trading sessions. So it's been a good move that you've seen on the Nifty itself. Moving to the October series. Now, we are making this point at the start of the series that the FIs, they are net short on the index. And at the start of the series, they were at 94%. Now, the short positioning has come down from around 94%. It's come down to around 83%. And we have got a good 1,000-point rally that we have seen. So that is the power of short covering on absolute display that we have seen. Moving to the options data, then the PCR, it had gone dancing away to around 1.45 odd. It's come back down. It's come down to around 1.21 or thereabouts. So that's a pretty okay level because the put writers, they are back into place. So we saw aggressive writing. The 25,500, 25,600, 25,650 and the 25,700 put. Good amount of open interest build up. And today, as I said, is going to be the weekly expiry. So these put writers, they are counting in on the lower levels holding out. So just for the day, I know we're going to have a gap up, but going by the options data, you have this 25,600 odd as a support level. And the bulls, they have their eye on fresh all-time highs. And I think just going by the momentum, going by the flows and the news flow as well that we have, even the results that are coming in there, we could be at these all-time highs sooner rather than later. So that's the call out there. Just a couple of words of caution are there. In Friday's trading session, the Nifty moved up. We had the VIX as well moving up. That normally doesn't happen. So just keep an eye out. Anyways, the VIX is at bombed out levels. And one more point is the headline index felt very good, but many portfolios didn't feel that good because the broader markets actually underperformed in Friday's trading session. Nifty went dancing away. The breadth of the market didn't really keep up. So you would actually like the mid and the small caps as well to participate, because that's what makes portfolios feel good. RBL Bank is the stock you're going to be looking at. The long-awaited deal has happened. The stock is in the FNO band, so that adds the element of excitement as well. Could be a big re-rating. Though the stock has run up, when it's moved into the FNO band, I'll tell you what, the shorts, they'll be fretting in today's trading session. So keep an eye out on this one.
Okay. All right, Nigel, thanks very much for that. RBL Bank, indeed, the big news over the weekend. And of course, we'll tell you more about it and what it means and how this open offer is going to play out. Big, stake purchase coming in from Emirates NBD. But for the time being, just a quick glance across Asia, and many of the markets like Singapore actually are shut for Diwali holidays. The ones that are trading are seeing a fair bit of green. The Hong Kong Hang Seng, for instance, has managed about a 2% up move. There's a lot of data out of China this morning. GDP numbers for the third quarter, and it is a little subdued. Chinese GDP has fallen below the 5% growth handle, so there's a bit of a slowdown, particularly in the property sector. For 9 months, the property investment part of the GDP, it's slumping almost 14%. So watch out for some of these cues. But for the time being, of course, we are going to put the spotlight on the Indian market and what it means. Foreign investors, like we mentioned, have now reduced the kind of the selling that they've been doing in this market, at least in the last couple of sessions. Prashant Paroda, portfolio manager, emerging markets at All Springs Global, is with us. Prashant, great to have you join in. Thanks for being with us. Season's greetings, wish you all at home and your team a very happy Diwali, all those who are celebrating. So let's start right there. Thankfully, the market has given investors reason to feel a little more cheerful this Diwali because things have started looking up here, whether it's flows, whether it's earnings. Your first thoughts on India?
Yeah, and happy Diwali to all of you as well and your viewers as well. So I think India is positioned pretty well going into the end of this year. We possibly have President Trump and Prime Minister Modi meeting happening at the end of October. Hopefully, there'll be some clarity on where the trade deal and the 50% tariffs, how it will impact at least the Indian export sectors. But overall, the earnings season has started on a pretty good note. You heard you just talking, Reliance retail numbers were better than expected. HDFC Bank was also close to expectations. So given the underperformance of India over the last year, I think if earnings come through, the market is well positioned into the next year as well.
Prashant, hi, morning. Looking spiffy over there. Happy Diwali.
Happy Diwali to you.
So should we, we started this year with, it's just been a frenetic year so far, right? So much news flow and you don't know, and beyond a point, no one knows anything, what's going on. But the market's kind of been, in a way, immune. Tariffs, what we began the year with tariffs as the big one, but it's kind of faded into the background. Even here in India, we've got these big tariffs which are on, but markets doing well. I mean, look at China. It's kind of, that noise has faded into the background, Prashant.
Yeah, the noise has faded because ultimately the market has understood that President Trump is looking to do deals. And the numbers, whether it's 50 or 100%, typically they do end up, if there's a deal, do end up coming down by a fair amount. So the market is kind of overlooking these kind of big announcements that come, because essentially the market is understanding that this is just a way for President Trump to sit across the table and do a deal.
All right. Hi, Prashant. Good morning. Good to see you, Ben. What about Chinese market? In the last 1 year or so, we have seen a big outperformance coming in from there. Do you think bulk of that has played out? It's time for a bit of a catch-up trade from the India market perspective, because they're no longer at 10, 11 times odd. I think it's moved more like 15 times. Do you think India has a chance now to outperform after underperforming last 12, 15 months?
Sure. And I think one of the things is on a sustained 15 times earnings level. Like the Chinese market hasn't held that for long periods of time. But what has helped China this year has been definitely the AI trade, and that has re-rated some of the big names such as Alibaba and Tencent. I think a lot of clarity will come from, again, President Trump and Xi uh, meeting possibly at the end of October as well on whether the semiconductors from NVIDIA and others do end up going to China or not, and whether rare earth happens or not. But underlying the economy, you mentioned the property numbers. Uh, not much is moving on the property front for China. So if the AI trade fizzles out sometime in the next year, I think that's a big risk to the Chinese market.
Okay, so we need to see what happens to that AI trade because till now, Prashant, most of those dips have been bought into. But actually, tell us that. I mean, that could be a big trigger. If the AI trade does fizzle out, then that's a massive move for fund flows around the world. What is the probability of that happening, you think? And what could the implications then be? I mean, should we get excited here in India if there is a fizzle out of that trade?
Yes, I think what investors and what your viewers should watch out for is that whenever there's a big capex announcement in US, the stocks move a lot. So Oracle and others, and it reminds me of what happened in 2006, 2007 in India, where a lot of the infrastructure plays announced kind of capex, and the stocks moved, but ultimately it's the execution that matters. So I think at some point these big moves will start fizzling out, and at that time you have to worry a lot about, because it's unclear to me whether OpenAI has the capital for all their pronouncements. And maybe, there's still some time for the AI trade to fizzle out, but I think when OpenAI becomes public, that's when we'll realize, what is the real valuation. And that might still take a year or so for that to happen.
All right, Prashant, we'll leave it there for now. Thank you very much for joining us. Really appreciate your time. Wishing you and your family a very happy Diwali once again. What we'll do is take a quick commercial break here. We'll come back and get straight to earnings because it's a financials-heavy morning, Monday morning. Lots of numbers over the weekend. There is an RBL deal as well we want to address. So coming up in just a bit. Okay, so coming up in just a bit from now, just to give you a teaser what's coming up here over the next 2.5 hours, 8:30, we'll discuss the Reliance numbers. Gaurav Malhotra of Axis Capital and Prabal Sen of ICICI Securities join in to talk about the various aspects of the Reliance numbers. We'll have at 9 o'clock R. Subramanya Kumar of Managing Director and CEO at RBL Bank, who will join in to talk about the big deal which has happened. 60% being picked up by Emirates NBD, $3 billion infusion into the bank. 9:20, we've got two special voices, N. Jayakumar of Prime Security, Sandeep Bhatia of Macquarie Capital. We'll talk market, stocks, and of course what to do in the new Samvat 2082. 9:30, Saurabh Gupta of Dixon joins us. So Dixon reported numbers and we'll talk about what the numbers mean and of course try and get a bit of guidance going forward for Dixon as well. Jayant Acharya of JSW Steel talks to us at 9:40 on the back of their earnings which came through. So lots to talk about there. 9:50 we'll be joined by the IDFC First Bank Management, V. Vaidyanathan. Again, second quarter very much in focus. We'll also have the management of Federal Bank. So Venkatraman Venkateswaran is the top boss at Federal Bank, and he'll talk to us about the business for the quarter and outlook forward. And Rajneesh Karnatak of Bank of India is our guest at 10:15, and it's focused on earnings once again. So sort of full run-through of four financial companies coming up over the next 2.5 hours or so here on Bazaar. We take that break. We come back with a research team and get you the stocks to watch out for.
Well, we've got lots and lots of stocks to talk about because while it was a festive weekend, it was also a very hectic weekend because a whole host of earnings, including a huge amount of financial numbers have come through. So we've got our team standing by. I think Gaurav is hardly at a weekend. So Gaurav, salute to you first. Lots of numbers to go over. But first, let's start with the big news. RBL Bank is in focus for reasons beyond numbers. Tell us more.
Well, yes, when we look at RBL Bank, first let's talk about numbers. Numbers were a mixed bag because profit that declined almost by 20% because of the higher provisions. But in this quarter, specifically beyond numbers, there is a story which is playing out is that NBD, Emirates NBD is going to buy 60% stake in RBL Bank for a cost of around 26,853 crores. Now remember, this will be as the largest ever FDI investment made in the Indian financial service sector and also the first acquisition of the majority interest in profitable bank by a foreign bank. With this, Emirates NBD will also be rolling out the mandatory open offer for 26% stake, and this will be at a price of around 280 rupees per share. Now, what we are taking is that open offer will be done first because optically it can, the stake can go up to 86%. So on the back of that, we will be seeing how much stake they will acquire finally. With this, the board of directors of NBD and RBL will also amalgamate the branches. And what post-acquisition, what we can see is that the NBD will be marked as a designated promoter of the bank. The benefits, first is that the infusion will result in 3 times net worth increase from 15,000 odd crores to around more than 42,000 crores. And this will also mark as the beginning of the bank's next growth chapter, which will be stronger, more diversified and future ready. Now, what's the next date we should be watching out at is the 12th of November, where EGM will happen, where they will seek shareholders' approval. And lastly, during the management con call, they also highlighted that NBD currently runs at around 19 to 20% ROE, and they also aim to reach that level. Remember, the ROE currently is around 5 to 6%. So definitely a big positive for RBL Bank. And on the back of that, we will be watching out on this stock today.
Okay, all right. Gaurav, get some rest over, the next couple of days. You've had a nice, hard-working weekend. Cheers, mate. Well done. But the other guy who's in focus today is Mangalam. Mangalam, I hope you're concentrating on work today. We've still got an entire day's trading session to go through. So tell us about Reliance first up.
Yep, there would be a firecracker coming in from Reliance as well, Nigel, this time around, because the results came in late on Friday evening. It's a good set. It's a top-down beat led by the O2C business and retail as well as digital services. So if you just look at the EBITDA of the company, closer to 46,000 crores. This compares with 42,900 crores quarter on quarter. And year on year, this number joins in with 39,000 crores. So a big bump up is what we've seen out there. Net profit coming in at 18,165 crores. Quarter on quarter, this is a dip largely because remember the last quarter, there was an exceptional gain on account of Asian Paints stake sale. But year on year, it is stronger than street expectations as well. What led the growth? Retail revenue. That grew 18.6%. The street was working with a number of 13 to 15%. Retail EBITDA as well grew much higher. In fact, Geo EBITDA too grew by about 17.5% as against street expectations. And we saw an expansion to the margins too. Brokerages, very happy. Nomura has said a buy. They have a target price of 1,700. Morgan Stanley has said this should get investor confidence back. In fact, re-rating is ahead as consumer retail is turning around and is beating expectations. And JP Morgan too has an overweight rating target near 1,700 rupees, telling you it's an operationally better quarter than expected. And they believe growth should sustain in the near term. That's about these reported numbers. Now the street will also be looking at what happens with the green energy business and strong plans that the company has for them.
Okay, all right. Mangalam, got it. Thanks very much. By the way, we will discuss Reliance full throttle, all the businesses, and of course the beat that has come through. We'll have our experts joining in, Gaurav Malhotra of Axis Capital, who will decode, of course, the telecom performance. Prabal Sen is going to be joining in to talk about the energy business as well. So more coming up on Reliance in just a bit. But for the time being, like we've been saying, it's Gaurav all the way. Gaurav, let's get to the big banks, ICICI Bank and HDFC Bank. I guess, Pretty heartening to see both of them chugging along fairly okay.
Well, yes, when we look at both the banks, they actually reported a more than expected number in terms of profit, and I'll tell you why. First, let's talk about HDFC Bank. When we look at net interest income, that increased by 5% on a year-on-year basis. Now, when we come to PPOP, which is pre-provisional operating profit, we saw a growth of around 13%, and this was because of the higher trading gains in this quarter. As a result, when it comes to profit, there also we saw a healthy growth of 11%, much higher than what the street was expecting. Now, the two positive points here is that first is that net interest margins that declined just by 8 basis points. This was in line with the street's expectation. And when it comes to the asset quality, now credit cost that remained contained. Now that came in at around 0.5%, again in line with the street's expectation. What is another positive is that we have already seen HDFC actually picking pace with the loan growth. And from here on, management again reiterated the fact that in FY27 they will outpace the industry. So that is something which is positive. When it comes to ICICI Bank, a strong beat here as well in terms of net interest margin specifically, because when we look at the numbers, net interest income increased by 7%, PPOP that increased almost by 3% on a year-on-year basis, but again net interest margins that fell only by 4 basis points versus the street's expectation of around more than 10 basis point fall. Apart from that, asset quality that also remained very healthy, and as a result, when we look at profit that increased by 5%, it was higher than the street's expectation. When it comes to loan book growth, that was at around 10%. It was again below their own track record that we have seen. But again, it was already anticipated by the street, so nothing to worry about. And during the con call, what they're saying is that the margins will remain range bound. And at the same time, NIMs were actually aided by the deposit rate reduction. So that is not something which we saw as a one-off in this quarter. So definitely good set of numbers by both banks. And on the back of that, we already saw brokerages, some of the brokerages also increasing their target price on both of these banks today.
Okay, all right, Gaurav, thanks a lot for that. Well, I'm looking at UltraTech Cement, and there were two factors that played out over the weekend. One was their numbers. The second factor was the long-awaited capacity expansion is what they're speaking about. First up, let's focus on the numbers. The numbers, well, on the top line was relatively better than what the street was working with, because realizations were better and volume growth as well at around 22%. That looked quite good. The problem was on the EBITDA number, there was a bit of a miss out there, and that's when the margins as well, there was a bit of a miss. Why is that? Despite having better operating leverage that played out and better pricing, the problem was other expenditure moved up because they had a maintenance shutdown. The other factor was that the raw material cost spiked up a little bit, and there were some, annual increments that were given. Because of that, the margins came relatively lower than what the street was working with. However, out of the 200 rupees per ton hit that they saw in the past quarter, the management says closer around 100 rupees per ton will be made up in quarter 3. So the stock could open up in the red, but the outlook from here on is that some of that cost hit will get recovered in the coming quarter itself. Moving to the capacity expansion, massive expansion. The phase 4 has been announced, 10,000 crores. They're looking to expand capacity by around 22 million tons at just $52 on a per ton basis. The IRR are at around 20%, and also net debt to EBITDA, they'll maintain it at sub 1. So that's positive. It could put some pressure on players, particularly in North India, because this foray is particularly in North India. So stock opens up in the red, and I'll keep an eye out on some of those north-based companies, because suddenly UltraTech Cement is turning on the heat after focusing on south and west. They're looking at north as well as east. That said, back to Gaurav. IndusInd Bank as well as Federal Bank. Tell us, how are those numbers?
Well, as IndusInd Bank, the numbers were not as great. Remember, the street is expecting some turnaround, but it seems that the turnaround is not coming, at least in terms of numbers. Because when we look at net interest income, that declined almost by 17%. PPOP declined almost by 45% on a year-on-year basis. Now, this was again anticipated by the street to have the weaker numbers. But what came in as a surprise is that bank actually reported losses of around 437 crores versus the estimations of around profit of around 300 crores on a year-on-year basis. Now, what remained and what actually led to this losses is that bank accelerated the write-offs as well as they increased the provisions in MFI. Management says that this will strengthen the balance sheet, but at the same time, ROA has taken a hit, and that is the reason why that came in as a negative news. When it comes to credit costs, because of higher provisions, that increased almost by 100 basis point, and at the same time slippages also remain stable. Apart from that, when we look at the management commentary, they are saying that the credit cost is not likely to see any kind of ease off, like a sharp ease off, at least in the near future. But when it comes to Federal Bank, now on the flip side, Federal Bank came up with very good set of numbers. In fact, we saw beat across the parameters. Net interest income, PPOP, both increased almost by 5%, although profit has declined, but it was again contained lower than the street's expectation. When we look at advances and deposits, advances grew almost by 6.2%, but a key thing to highlight is that despite having a slower growth when it comes to net interest margins. They have expanded their net interest margins almost by 12 basis points. And in terms of credit cost also, they have reported credit cost of around 0.5% versus their own guidance of 0.55. So definitely good set of number actually given by the bank. During the con call, they also remained optimistic about the growth going ahead because the pockets of growth where they saw in this quarter were actually healthy. Second thing to watch out for is that 24th October is a date where board meeting will happen for Federal Bank, where they will consider fundraising via equity. Remember, the CET and CRAR ratio both are actually at a healthy level, and in fact during the con call, management neither denied nor confirmed if it is going to be an enabling provision. So that definitely that is something which will keep the stock in a buzz. But all in all, in terms of numbers also, very good set of numbers posted by Federal Bank in this quarter.
No, absolutely. And by the way, you'll hear from the Federal Bank management a little later here on the program. So keep an eye out on that one. We want to focus on two other numbers, right? Dixon, again, the management joins us later at 9:30, and Havells as well. Upasana is here with details on both. Upasana, morning.
Good morning. First up, let me start with Dixon Technologies. Well, the company has reported in-line set of numbers. Revenue, PAT, margin, all three are in line with our poll. Now, if we look at the Q2 sequential mobile volume growth, it stands at 13% versus guidance given by the company in Q1, which was 15%. So it is a miss on that front. Now, coming to the company's key segment, that is the mobile and EMS segment, it has reported a strong revenue growth of 41%, while other segments have declined due to the deferred demand on GST rate cuts. Now, reported PAT was boosted mainly because of the fair value gains is what the company has indicated. Coming to the numbers now, revenue has seen an uptick of 29% on year-on-year basis. EBITDA has seen a growth of 32%. EBITDA margin stands at 3.8% with an uptick of 100 basis points, largely in line. And adjusted PAT has seen a growth of nearly about 15% on year-on-year basis. Now, coming to Havells India, the Q2 performance was below the street estimates because of the weakness seen in Lloyd Consumer. Company has reported a top-line growth of 5% with the key segment cables and wires reporting a revenue growth of 12%, followed by lighting and fixtures at 8% and switchgears at 8% as well. Now, company's margin has come in lower this time around because of the Lloyd PBIT, which the loss in this has widened from 22 crore to as high as 99 crore on year-on-year basis. Company has also said that the cooling products saw sharp degrowth due to unseasonal rains, short summers and even high inventory. Coming to the numbers now, revenue has seen an uptick of 5%, EBITDA has seen an uptick of 16%, EBITDA margin stood at 9.2% versus the street estimates of 9.6%, and PAT has seen an uptick of 17% on year-on-year basis.
Okay, all right, Upasana, got that. Thank you very much. So we'll keep both Dixon and Havells on our radar as well. Let's round it up then with Vivek. He's watching out for numbers from JSW Energy. Vivek, how do they look?
Well, good morning. Largely inline set of results on the back of the fact that the company had acquired two large entities, both O2 Power as well as KSK Mahanadi. Revenue surged almost 60% on a year-on-year basis. EBITDA higher by 77%. EBITDA margin quite strong, over 50 basis point improvement. But profitability, however, was impacted by multiple one-off factors. So profitability actually fell 17% on a year-on-year basis. What impacted the profitability? Number one, lower operating profit in both Karcham as well as Baspa. Now, this was due to an adverse Supreme Court ruling as far as free power distribution was concerned. On the back of that, EBITDA took a hit. But you also saw a bit of a hit coming in from the fact that Utkal actually operated at lower PLF this time around. Profit, however, was aided by both O2 as well as KSK Mahanadi ramping up quicker than expected. We'll hear from the management later today. Expect a mild green on the stock once market opens.
All right, guys. Thanks a lot for joining in, giving us a quick take on all those stocks. Happy Diwali. We'll catch up post the show. Well, here's a quick recap of all the top stocks that we just covered. The ones with positive news flow: Reliance Industries, RBL Bank, ICICI Bank, Federal Bank, Dixon as well as JSW Energy. On the flip side, the ones with negative news flow: HDFC Bank, Ultratech Cement, IndusInd Bank, as well as Havells. Well, that's about the equity markets. Manisha Gupta joins in to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, which are now trading at a 6-month lows. We've seen constant declines onto this one in the month of September. October seems to be going the same way. And when you look at this current year, we are down by 15% for the crude oil prices. Well, it has to do with rising supplies from OPEC members, cooling tensions at the Middle East. And the markets will watch out for the US and China trade talks this week. That is going to be the big cue for most asset classes. When it comes to precious metals, well, we have seen a bit of a pause come in here as well. After those all-time highs in gold and silver, Friday was a day that you saw gold prices decline 2%, silver was down 6% as well. With the trade tensions easing, ceasefire more or less continuing in the Middle East, and then, of course, a profit taking after that very, very strong run-up is what the markets are dealing with. But after Friday, Monday morning, and China seems to be buying yet again, is the reason you're looking at 0.5% of gain coming back into these markets. So support for precious metals more or less continues.
Okay, all right, Manisha, got that. Thank you very much, and we'll touch base with you again very, very soon. Need to take a break right now. When we come back after the break, it's Reliance Full Throttle. As promised, we get you a full perspective on all the businesses, whether it's retail, whether it's telecom, and of course, the energy business as well, oil to chemicals as well, all of that coming up with a conversation with Gaurav Malhotra and Prabal Sen. Back with that in just a bit. Welcome back. So it's all eyes on Reliance Industries now. Numbers came in after market hours on Friday. And Reliance seems to be firing on all cylinders. The retail business continues to do well. Consumer-facing businesses are really leading the growth. But even the energy business, I mean, whether you're looking at oil to chemicals, there has been improvement. So let's discuss the individual verticals with the respective experts. We have Gaurav Malhotra joining in from Axis Capital to talk telecom and what Jio has done and what the expectations are for the rest of the year. And of course, we have Prabal Sen, who tracks the energy space at ICICI Securities. Gentlemen, thank you for joining in and wish you both a very, very happy Diwali, first of all. And looking at Reliance earnings, I think investors can also take some heart and it's in line with the festive spirit, perhaps. Prabal, let me open with you. What did you make of the energy business and the performance? Because the past 1-2 quarters, we were talking about the oil to chemicals business, facing some issues with cracks not, rising, etc. But some of that seems to be behind Reliance in the quarter gone by. Your thoughts?
Yeah, good morning and a very happy Diwali to everyone sitting there around your families. I think two things. One is that product spreads or diesel and ATF in particular and gasoline to a certain extent have definitely expanded well beyond what they have been in the previous few quarters. So that is certainly helping the OTC business. And I think the outlook for diesel spreads and ATF spreads continues to be strong. Gasoline, it's a little bit of a mixed bag, but at least as of now, the spreads are holding up. Even for petchem, domestic demand I think continues to remain strong, even though margins there are a little bit over the place, and that is where the integrated nature of operations of Reliance helps a bit. So on an overall basis, I think the demand supply balance seems to be getting a little bit better. Particularly as far as refining is concerned. And in petchem also, I think after a very, very long period of sustained underperformance, at the margin, at least things seem to be stabilizing or at least improving on at least certain value chains. Polyester still remains weak, but polymer and plastics seem to be doing a little bit better. So on the whole, I think fairly encouraging set of numbers.
Yeah, so looking good. And talking about the second half, Prabal, on the energy side, what would your expectations be?
Honestly, given how volatile margins have been, it's a very, very, very difficult sort of task to sort of look at, what to project. But as I said, at the margin, I think things seem to be looking up. There seems to be more of an upside risk to spreads rather than downside at this point of time. So I would expect that the quarterly run rate of EBITDA would hopefully sustain at these 15 to 15,500 crore kind of a level. At least that is something that seems, is basically what our base case is at this point of time.
Okay, I'll come back to new energy in just a bit. Prabal, just stay with us. Let's also talk telecom, because there we've seen sustained improvement. The EBITDA is continuing to sort of notch higher and higher, and it's finally crossed 211. Not the EBITDA, beg your pardon, the ARPU that is. And even the EBITDA, there is expansion on the EBITDA and on the EBITDA margin front as well. So it's been good going for Jio. Gaurav, did it meet the mark for you?
Yeah, hi, good morning, everyone. Yeah, see, Jio was a decent set of results, right? The top line growth was both on the back of healthy subscriber additions, right? One of the highest in the last few quarters, and also the steady uptick in the ARPU, right? And that steady uptick in ARPU is basically happening because there is more data being consumed, there is some premiumization happening. So from a revenue top line from a revenue growth perspective, it was a good set. And from a margin perspective, given that 5G capex is almost behind us, right? The network utilization is increasing on a quarter-on-quarter basis. So there is benefit of operating leverage. So nothing to sort of complain. Overall, a good set of numbers.
Okay, nothing to complain, that's fine. But now, again, Gaurav, same question. It's all about the future, right? So the benefits of the tariff hike have flown through, and the data consumption continues to go higher. But would you expect anything, any new triggers from the telecom business going into the next couple of quarters?
See, in terms of the big trigger, obviously the big trigger continues to remain the tariff hike. It's there in analyst numbers, but obviously as and when it happens, that does create some sort of an excitement. The other trigger, which is a little bit smaller in the overall context of Jio, is the steady increase in broadband, right? That is something which the company is seeing a pretty healthy net adds. And these net adds are happening not just on fixed broadband, but also on FWA. So the investments which the company did in rolling out 5G on standalone, that seems to be bearing fruit. So it almost has like a 70-80% market share of the fixed wireless broadband additions, which is happening on a month-on-month basis. It's in the overall context of Jio, like I said, it's relatively small, but nonetheless, right, that is a decent growth. And obviously, the Jio platform business continues to do well. So the big trigger continues to remain tariff. Then obviously your steady uptick in broadbands and the steady increase in Jio platform growth profile.
Okay. Fair. On the tariff, do you have any timelines in mind and quantum? What do your estimates right now bake in, Gaurav?
See, the thing is, the way to think about is that there have been 3 major hikes in the past since 2019. The quantum of hike has steadily reduced, but the absorption of those tariff hikes in ARPU of operators has moved up substantially. So the way we are thinking about is that the next hike does not have to be very large. So we are looking at like a 10-12% tariff hike. And from a timeline perspective, we are thinking somewhere between December 25 to June 26.
Okay. So basically in 2026, we could see another leg up on those telecom tariffs. Got that point. Prabal, now talking new energy. And I think that the cell facility could be starting next month itself. Correct me if I'm wrong, but I think that's what we were working with. What was the additional read-through you got from all the commentary that Reliance gave out? And how are you, sort of valuing and, assessing the new energy business?
Yeah, so I think the fact that the timelines continue to be sort of accelerated, and the fact that there's tangible progress in terms of plans, specifically on the solar module front and the cell manufacturing plants that they have, and as you mentioned, the commissioning deadlines are sort of within the next 12 months. There could be meaningful additions to some of those plans. So that obviously brings forward the monetization of the initial plans of 75,000 odd crore of capex. So obviously, I think one will have to sort of look at, given that the monetization plan involves essentially the captive use of the solar power that we produced in the phase 1 of the additions that is happening in terms of modules and on to generation. So I think that is something that will reflect in terms of OTC costs, seeing a meaningful, upside. And I think that is something that will be interesting to watch. At the moment, frankly, we don't model for the revenues from this segment separately. We model it at just about 1.5 times capital employed of the 75,000 initial plan. So as and when numbers start flowing in and we actually see the results on the ground of initial commissioning, we would obviously sort of look at it in a more detailed way. But it is very promising in terms of the way that the timelines are being met and exceeded, and internal targets are extremely aggressive in terms of commissioning of each of the 4 gigafactories that are actually planned over the next few years.
Absolutely. We're going to watch out for all of those timelines, and the commissioning. One of those facilities perhaps kickstarts next month itself. Very helpful conversation, gentlemen. Thank you so much for joining in and giving us a view on 2 of Reliance's key businesses, the energy business, of course, and telecom, and wish you a very happy festive season with your families and, of course, your team members. Thanks for joining in. But Prashant, speaking oil and gas, I mean, every time you hear the word oil in India, it leads you to the, to the non-stop back and forth that's happening. I think there was another statement, right, on board Air Force One, on whether we will buy Russian oil or not buy Russian oil.
It's only fourth and fourth. There's no back. Seems to be, right? So President Trump last week said that he's spoken to Prime Minister Modi, and that he's been promised that we will stop buying Russian oil. There was a Ministry of External Affairs
Which was
statement.
a very clean, clinical statement. Didn't say too much.
He didn't say yes or no,
Exactly.
but basically kind of sort of said that, well, it repeated that we'll
national
take a call.
interest. Yeah,
Exactly.
yeah.
And now it looks like President Trump has made that claim again, that he's spoken to President Modi, and he said, well, they've promised not to do that Russian thing. So let's just actually listen into that soundbite, because I think, everything has been done. This is perhaps the last remaining bit, right, with regards to, from a financial market perspective as well, this trade issue with the US. So in that sense, this is important. So just want to play that soundbite out for you.
I spoke with Prime Minister Modi of India, and he said he's not going to be doing the Russian oil thing, so that's it.
Well, why would India say that they're not going to do?
I don't know, but if they want to say that, then they'll just continue to pay massive tariffs, and they don't want to do that.
Welcome back. Well, let's get in Mitesh Thakur of Bonanza Portfolio, who joins us on the show. Hi, Mitesh. Good morning. Happy Diwali to you, your family. Wish your son, especially for us. Had a good time with him on the floor in the past year on our newsroom. But tell us, what is your view on the index? We're going to be gapping up 200 points today. What would you say? Take money off the table or ride it?
Morning, Nigel, and before the market call, wishing you, the entire team of CNBC and your family a very, very happy and joyful Diwali. For today, I think, what will happen is that we have about 200 plus point kind of a gap up possibility according to the gift nifty. And that would mean that we might be very close to about 26,000 levels. Now, 26,150 is a gap area, which happened, I think, on the 30th of September. And 26,230, I think, is the 220 is the highest closing which we got on the Nifty. So I think as we get closer to 26,000, let's not forget we're also getting slightly overbought. And my idea would be that as we get close to 26,000, at least start booking some profits on your long positions, especially if they are with a short-term trading view. And around 26,150, I would want to at least book more than 75 to 80% of the Nifty long as well as stock long positions. Wait for a decline. The directional bias is on the upside. But given the fact that we'll be very overbought, hitting some important supply pivots, I think between 26,000 and 26,150, I would be very keen to take profits off the table.
Okay, all right. So that's the trading strategy on the index. Mitesh, happy Diwali to you. Markets giving reason to investors to feel a little, joyful. Stocks for the day as well, please.
Extremely joyful. Good morning, Surabhi, and a very happy Diwali to you and your family.
Thank you.
On the stock side, I have more of buy calls, 3 buys to 1 sell. I have a sell despite the fact that, the gift nifty is very positive, and that's on Infosys. It had a gap down on Friday, broke below a trend line level. There was jump in volumes. The setup is slightly negative. So if you get a 5-10 points kind of a bounce back on Infosys in the morning, sell between the range of 1445 to about 1450. Keep a stop at 1465 and look for a target of 1410. But the rest 3 calls are on the buying side. ITC, I think, gave a very strong reversal on Thursday and Friday. So buy with a stop at 407 for targets of 424. Also a buy on Max Health, which had a gap up and sustained. So that looks like a continuation gap, which should see more upside. So buy here with a stop at 1188 for targets of 1235. And finally, a buy on APL Apollo with a stop at about 1734. Look for targets of 1795.
Okay, got it. Mitesh, thanks very much. We'll come back to you a little closer to market opening. Right now, we do have to take a very quick break. We'll come back almost touching 9 a.m., so we'll have the pre-open rates. And also, that conversation with the management of RBL Bank, what a mega deal as Emirates NBD is checking in to buy a 60% stake. It is probably the largest FDI that we've seen in the Indian financial sector in a long time. We get you that conversation right after the break. Welcome back. We've got about 2 minutes to go before we start getting the pre-open rates. Will the Nifty extend its winning run as we get into the full throttle Diwali festive cheer? Sudarshan Sukhani has also joined in, so let's quickly get his trading setup. Sudarshan, happy Diwali to you, your team, and everybody at home. Tell us on the index, what's the call today?
Happy Diwali to you. We are celebrating Lakshmi Puja today. So good wishes to everyone. See, the Nifty has been on a roll, and I don't have to make a call to say how high it will go. The important point is that we should be long. This is a theme we have developed over the last 10 days, 15 days. Stay long in the Nifty, buy on dips, buy small consolidations. And even if we have a 2-day holiday, just keep long positions, use options instead. I also have a suggestion, a Diwali suggestion. The Diwali buy is to buy Nifty ETFs. This is the easiest way to enter the stock market without any tension and apprehension. And the one thing you should not do is to buy gold and silver. They are in bubble territory. Avoid that. Focus on the Nifty.
Okay, all right. And that's a nice tip to anyone who's new to the world of investing. Definitely get those Nifty ETFs. An interesting call on gold and silver. But let's talk stocks as well, Sudarshan. What's on your list for the day?
Well, Zydus Life is a buying opportunity with a stop under 970. Bharat Dynamics is a buy with a stop under 1510. Tata Consumer is a buying opportunity with a stop under 1145. And just to balance it a little, I have Manappuram, which is an intraday short, only intraday, with a stop above 290. But broadly in this market, we should try to be on the long side.
Okay. All right. Sudarshan, happy Diwali to you and your family. Thanks very much for joining us as always. Now to the big banking story, right? Diwali Dhamaka. UAE-based Emirates NBD Bank is set to acquire a controlling stake. It's the largest single-ticket FDI item in the Indian financial space. $3 billion infusion. That's about 27,000 crores into RBL Bank. And they end up with a 60% stake, maybe more, depending on how much shares come in that open offer. So I sat down with the top management at RBL Bank, the MD and CEO, R. Subramanya Kumar, to decode what this means for the bank going forward. Listen in to this conversation.
I feel that with the current trending and the core value which we are likely to create with this deal, I don't think that the people will be looking at responding to the open offer, because it is going to be something which co-creation of the value. And this huge investment which is coming into the bank will also improve the book value also. Yes. When the book value moves up, this is something which is going to add up to your market value. Market cap will go up. So taking all these considerations, I feel, it's open offer may not kick in much of the numbers. And it is hovering around 60, plus the branch merger, whatever the percentage is going to come.
Okay. The brand remains RBL, or will they be? It's going to be a combination of their name, your name.
So the entire discussion went around the brand strength. Today, if you look at it, the RBL has created its own strength, and specific discussions have not taken place with regard to that. But left to my thinking, I feel that the greater part of the RBL will remain as it is. And it is not a part of our CP or conditions or anything. Otherwise, you would have seen it in our IA itself.
But it's possible that, they may be accommodated.
They may be, correct.
Down the line.
Not immediately. Immediately, it is going to be the RBL to start with. And we have to wait for the things to evolve, rather than taking a preemptive thought in that.
The RBI, of course, will take a look at the deal. There are all these other sort of regulatory aspects as well. But I assume there would be some amount of comfort. You would have sort of gotten that this is kosher, fit, meets fit and proper. All of that, this is formality in that sense. Obviously, it's not formality, it is done. Formality. But I just wanted to get a sense.
Yeah, absolutely, Prashant. It can't be a formality. Sure. It is a very deep evaluation of it.
Sure.
Why we feel that the fit and proper may not be an issue is that they have already participated in elsewhere, and they have also been given an in-principle approval for the WAS.
Sure.
So the fit and proper may not be an issue. However, the regulator has its own deeper understanding and evaluation technique. We can't say beyond this.
Let's get to the size of what this enables you to do, right? I think the net worth goes up to about 42,000 crores. So from 15 it goes to 42. Your leverage right now is about 8, slightly over 8 times or so, right? Assets are about 1 lakh crore. What does this enable you to do in terms of growing that asset book, loan book?
This gives enormous opportunity. Just for understanding, today my capital adequacy is, my CRAR is around 15%.
15,
1.5.
Right.
For the discussion purpose of understanding, let us hold it there.
Yeah.
Right. In the expanded capital of 42,000, I am going to maintain that as a set aside for the purpose of regulatory capital.
Sure.
So somewhere around 6,000 crores or something like will be set aside. So the remaining around 35,000 crores is something is going to be available for us to expand the business, taking some investment part of it and other things, and a conservative of around 8 times because some of the will go for distribution investment and things like that, technology upgradation and things like that. Leaving those aside, possibly the very rough calculation will make us 8 times if I do it, and it has an ability to grow the asset to the tune of around 2.5 lakh crores. This is something which is a big opportunity. This is not a one year story; it's a 3 to 5 year story. What we have been thinking among ourselves. However, the deeper calculations are required to be done, and will work much better. During this period, we will continue to make a profit, and I'm sure that the profit will also enable us to scale a little higher. So the combination will make us to take it to the better league than where we are today.
So everything remaining same, which is you holding at the capital adequacy of current capital adequacy, not going up to 20%.
Yes.
From 1 lakh, you can go up to about 2.5 lakh crores over the next 3 years.
Exactly.
Or so, right?
That's opportunity available for us.
And will you hold at the current capital adequacy? Will you go to 20?
No, the most ideal situation will be to have around 17-18%. That is what we wanted to have it because of the environment in which we need to have a strong capitalized bank. We don't want to be in the 15 range. That is a natural thing. And as we move forward, we will evaluate a little deeper to see that should I hold it at 17-18% or go to 20%. The most ideal situation will be around 18% will be something which is going to help us out to sustain this.
NBD is AAA rated.
Yeah.
51% owned by the government. What does this give you a lift as well in terms of cost of borrowing, etc. for you?
I strongly believe this is going to get our credit rating revised. We are now AA minus. And naturally, this synergy is going to be you are strongly capitalized, your future growth is assured, and you have bigger opportunity to make the better things. And there will be positive rating upgrade for the bank is concerned. There is every possibility.
Could you talk to us a little bit about the cost of funds? I mean, what is it right now? What's the expectation over a period of time as this materializes?
See, today, if I look at it in my overall cost of funds in here, savings fund, we are able to bring it down from around 6.54 to around 5.3. There is a big down. That is mainly because of we recalibrated the rate at which we are paying it to them. Where peak was somewhere around 7.25, which we brought it down to 6.25. Similarly, in respect of the TD, we were at the peak of around 7.25, which we brought it down to 6.75. These two things have already reduced my cost. And the FD, almost everything has been rewritten the last 1 or 2 quarters. A little portion of it is getting rewritten. My residual maturity is somewhere around 11 to 12 months. So if I look at it, this is the natural corrections have happened because of the repo rate correction which has happened here. And 1%, we already reduced our savings rate by 125%. In respect of FD, we have reduced around almost around near 100. This particular deal will enable us to get much better with regard to that rating of the deposits. We are confident that our rate of deposit, the rate at which we are offering the FD as well as the savings will definitely substantially come down, which will reduce our cost of deposit. When our cost of deposit comes down, our ability, and because the re-rating of the bank and rating of the bank goes up, our ability to borrow at the cheaper rate is also going to come up.
Sure.
So the overall, if you look at it, my
could
cost
you put
of
some
funds,
numbers to it roughly? I mean, I won't hold you to it, but broadly, how do you think about this?
See,
on a blended basis, what's the advantage?
I mean, in my rough mental calculation, I need to back check my numbers again. Maybe around 100 bips, 125 bips will be the reduction, what we'll be able to see that in respect of our cost of funds and cost of deposits over a period of 1 to 2 years from what it is at current level.
100 to 125 basis points reduction in cost of funds.
Cost of funds as well as the cost of deposits.
So what does that do to margins then?
See, today the margin we are holding it around 4.5 and we have a plan of action to take the margin to somewhere around 4.8 during this current year itself, which we thought that we'll be able to hold it. And we have around 40% of our total advances in the fixed rate, which will be continued to hold it that way only. And since we are able to get a lower cost of this thing, my ability to lend at AAA as well as the housing loan, which we are holding back today, will shoot up. although it may not alter my margin in a big way, the reduction of the cost is going to help us out in reducing the margin. There will be upward trend from once it is consummated, the NIM will start moving up. In my rough calculation again, in a year's time, it may move up by around 10 bips and keep increasing by around 10-15 bips as the advances are increasing it and my interest income goes up.
So NIMs may improve by 10 basis points and then keep improving perhaps.
Keep improving it as my book grows and my NII increase it. Our intent is to grow the NII at least faster than that of our advances.
What does it do to return ratios? I mean, ROAs and then subsequently ROE?
See, today our ROA, we are intent to reach around 1% exit ROA with the current setup. So when you are going to get such a huge influx of the fund, the capital, which is interest-free, that is automatically going to kick up my ROA maybe around 0.5%, 0.7%, depending on exact calculation we have to do that. So my ROA by design will go up because of this capital infusion. And with the higher margin we are thinking of and with the reduction of the OPEX, which is one of the another big focus area for the bank. And my provision will also come down. The credit cost is going to come down. The trending well. The MFI is almost on near normal. I think credit card in another 1 or 2 quarters will become normal. With these things put together, it is going to kick up my ability to move up my ROA by another 0.1. See, our current business will facilitate us to improve the ROA around 10 to 15% year on year.
Sure.
This new addition will facilitate us to increase it by around 30-40%.
Okay.
So both put together, possibly in the first instant year, we will be able to grow by around 40 to 50%. Thereafter, it will be in the range of around 10 to 15% year on year.
There is though large expansion of my equity. So in terms of return on equity, you think, I mean, at least for the next few years, you are...
Few years, yes. I fully agree with you. The base has increased multifold from that other 60 crores to 150 crores. So naturally, it will have its impact on ROE. But in the next 2 to 3 years, with an accelerated growth, what we are looking at, an accelerated path we are looking at, then it will be in a position to come back to its double digit, maybe in another 2 to 3 years' time.
But over the next couple of years should be 6-7% in that range?
See, next 2 years, maybe in the high teens. So maybe after 3-4 years, it will go back to its around maybe around 12-13%, and then it will start improving it thereafter in an accelerated way.
Well, that is the conversation with the RBL Bank MD and CEO. And look at the stock; it's opened up. It's actually the pre-open has come to an end, and the stock's kind of flattish, slightly higher, around the 300 rupee mark. I mean, you know, the management very candidly admitting that. The way this is structured is there is an open offer first, and then there is a pref issue, and there is a SEBI there's a SEBI rule which allows them to scale down open offer because, I mean, you know, foreign banks, foreign entities can't hold more than 74%. In any case, there is the minimum public float holding. So realistically, given the difference between the offer price and the current market price, I mean, not very many shares may come into in the open offer. So around 60%, slightly over 60% is a realistic expectation. But it's a $3 billion sort of infusion, 42,000 crores net worth, 8 times leverage, which basically means that from current 1 lakh crore in assets, loans, I mean, you know, they basically can go up to about 2.5 lakh crores over the next 3 years, 3 to 5 years, depending on how they want to scale it. So that's RBL for you. I already am seeing a few sort of upgrades from brokers, etc. was very well anticipated. We reported it, many others reported it as well over the last 2 or 3 weeks. But, I mean, the deal's finally in the bag, it's finally done. Just want to get 9-10 calls out of the way, and then we'll, of course, keep coming back to this big story and this big deal over the next few hours. Sudarshan and Mitesh are back with us. Sudarshan, your 9-10 call?
Well, it's Bharat Dynamics. Buy with a stop under 1510.
Okay, BDL. Mitesh, what about you?
I'll go with the buy on ITC for targets of 424.
Sorry, which one, Mitesh?
ITC.
ITC. Okay, BDL and ITC from Sudarshan and Mitesh. Gentlemen, thanks very much, both of you. Appreciate it. Let's just revisit the bank earnings, right? I mean, lots to tackle. Gaurav is standing by with the fine print. And of course, I mean, the punchiest here. Gaurav, over to you.
Well, yes, when we talk about the big banks, first let's talk about HDFC Bank. Inline set of number is what we saw. Profit increase almost by 11%, while we saw net interest margins declining just by 8 basis points, but it was in line with the street's expectation. What remained positive is that the commentary that FY27 will be higher than industry growth, and at the same time, the credit cost that actually also came as a surprise, because it is positive that bank is keeping the credit cost at a healthy level. When we talk about ICICI Bank, we saw profit actually was higher than estimated, and the reason being that provisions, those were lower than what the street is expecting. In fact, another big positive surprise here was that net interest margins, they declined just by 4 basis points versus the expectation of 12 basis point decline on a sequential basis. And during the con call as well, they said the margins are likely to remain range bound. Apart from that, let's talk about IndusInd Bank as well. When we look at the numbers, those were, the expectations were weak, but on the back of that also, bank actually reported losses of around 437 crores. Now, what impacted is that the provisions, those were high. Bank said that they took accelerated write-offs as well as increased provision on microfinance loans. Apart from that, during the con call, they also said that it is not going to be significantly decline in the credit cost in the next 2 quarters at least. So definitely on the back of these updates, we are going to watch out on all these big banks and how they trade today.
All right, Gaurav, and we'll come back to you for more. Thanks very much for joining us. That's essentially the initial first take as far as these numbers are concerned. What do we have? I think market open coming up in a few seconds from now. And we will take stock of the indices as we always do. And then we'll dive into individual stocks and sectors, etc. So the opening coming up on the big wall here. First rates on your screen. It's a 100-point uptick. 25,800 plus is where the Nifty is now opening at. 850, by the way. Nifty Bank at 58,000. So ticking slightly above the 58,000 level. Mid-cap index is up 0.5%. The small-cap index is opening about 0.25% higher as well. So it's a pretty good week after what's been a pretty fantastic last 2 weeks, actually. So 0.75% now, closer to 25,900. So racing away to 25,900, right at the word go. Let's see if you're able to hold on to some of these gains through the course of the session. That is important. Tomorrow, it's a bit truncated in that sense. Tomorrow, of course, there's about an hour worth of trading. The Maurud session, day after is a holiday. So there's that, but it's pretty good. 25,900 nearly. And look at the Nifty heat map as it comes up on your screen. You've got pretty much everything in the green, just 3 or 4 stocks which are down in the red at this point in time. A pretty green looking screen all told. Surbhi.
Oh, it's the banks all the way. Look at the bank Nifty. It continues its charge, 500 points up at the start. But before we talk about banks, and there's so many to go over, Reliance is, taking the market higher. It is the opening batsman in leadership position, almost 3% up after its earnings. So you've got Reliance firing. You've got, of course, the banks. Now, Kotak, Axis, these are the ones that are leading. Interestingly, there's some selling on ICICI Bank. The numbers are very, very decent. The NIM compression was far lower than what the street had feared. But for the time being, there's a bit of a sell on, or basically profit taking, sell on news playing out, 2% lower over there. Ultratech Cement is slightly lower after earnings 1% down. But other than that, the Nifty is a nice bright shade of green, 200 points up. So let's see what the other winners are looking like. Kotak Mahindra Bank, Axis Bank, Shriram Finance, Bajaj Finance, Bajaj Finserv. So it's financials all the way, banks as well as non-banks. And then you have some other names like Titan, Infosys. They're pitching in as well. HDFC Bank as well, also reacting to numbers. Steady quarter coming in for HDFC Bank, about 1% up. SBI as well, almost 1% higher. But the bigger bank reactions are actually in the broader market with the likes of DCB, etc., Nigel.
Well, DCB, that's the stock of the morning. That's up close to around 10%. It's firing away. The NIMs have expanded. Credit costs are around 0.3%. Guidance of very, very strong out here. And keep in mind, the bank trades at around 0.7 times price to book. That's on FY27 numbers. And the medium-term ROEs is in that vicinity of around 12 to around 13%. So some brokerages are pointing out that risk reward actually is favorable. AU Small Finance Bank bursting away. NIMs have expanded by close to around 5 basis points. Quarter on quarter, the credit cost guidance at sub 1%. The street loves it. Just take a look at that. When you have big deals taking place with regard to Yes Bank, with regard to RBL Bank, well, the street now is a little bit more excited. Even if you look at Federal Bank, just pull up the stock out there. That's up close to around 7%. The numbers look pretty good. The NIMs have expanded by 12 basis points on a quarter-quarter basis. And also, they'll be, meeting for a fundraise on October 24th. So the street likes that. That stock as well is bursting away. RBL Bank obviously is higher because of the big deal that's announced and post, the results as well. So all these banking names doing well from the broader markets. Jaiswal Nico, that's one stock that's up close to around 4% from the broader markets. It saw a correction of close to around 10%, but these numbers look good. EBITDA is now at around 300 crores on a quarterly run rate. The interest cost has come down substantially. So Jaiswal Nico is a stock from the broader markets that's doing well. But really the big boy that's doing all the heavy lifting today is Reliance Industries. In fine form, taking out some of those technical indicators as well. And that's doing the heavy lifting. So Reliance Industries and the Nifty Bank, well, coming together, that's a good combination. Explains why Nifty on its way to fresh all-time highs.
Just want to add two names on the downside as well, though it's a bright green morning. Just result reactions to watch out for. Look at Tejas Networks. I mean, the stock's being slammed about 7% lower. Once again, it's reported losses. There are losses at the EBITDA level and at the PAT level as well, and the market is in no mood for any of that. And the other one is UTI AMC. In terms of all the weekend result reactions, UTI was also a bit of a disappointment, some loss of market share as well. So that stock's down about 6%. So just pointing these out, but otherwise, the result reactions have been largely really good.
Just one more point, Prashant, I want to make on Hindustan Zinc. The stock is down. I'll tell you what, everyone's talking about silver at $50 and whether it's good or not. I'll tell you what, Hindustan Zinc, they have hedged close to around 130 tons of silver at $37 per ton. So talking about timing the market, the largest producer, only listed player.
Oh, hedged doesn't they purchase prices?
They have hedged, yeah. They're going to sell price. They'll be selling silver at $37 per ton. So that is at a sharp discount from $50 because they were expecting it to go to $41, $42, per ton. So even the best get it wrong. The largest producer has got it wrong. Close to around, that's close to 30% of their volumes hedged at a cost that's at a price that's much lower. But part for the cost, they got it wrong. It's much higher than the $30, when they started the year at. But that's market.
I wish I was the counterparty on the other side, on that hedge. On a lighter note, but yeah, that's quite something.
Right to be able to buy silver at 37.
At 37.
By the way, I want to just point out that silver Bs, and we have all these silver Bs, right? Silver Bs are down between 5 and 7%. So you look at, actually, I think this is the Nippon silver. No, this is the 6% lower, 152. If you can have actually all the silver ETFs essentially, and I think they're taking a bit of a setback this morning. Maybe just profit booking, right? These are financial instruments. Gold Bs, by the way, are down about 3% as well. There you go. Nippon ETF is down 6. Tata Silver ETF is down 5. HDFC Silver is down 6. And I think the Gold Bs is down a little bit as well, about 2.6 to 3%. Look at the volumes on some of this stuff. Huge, humongous. So that's something to note and keep an eye out on, apart from, of course, stocks, etc., which we are continuing to highlight. Surabhi mentioned Tejas Networks. It's on the downside, 7%. Whirlpool is down about 3%. Whirlpool had this massive move from about 1,100 all the way to about 1,250 in 2 days flat. That was Friday's high, 1,250. It's taking a bit of it's cooling off a little bit. Havells is down about 1%. Again, but volumes still very much on the upside. I mean, market breadth numerically more down than up, but volumes are with stocks which are higher. RBL Bank I saw with a 4% pop, and maybe we should just look at that as well. RBL Bank is up about 3%, 307, 308. So the price is running away after that $3 billion infusion, which has come. And the stock, by the way, has done well into this particular transaction. I have N. Jayakumar with us, Group CEO and Managing Director at Prime Securities. Jakes, good morning. Great to have you with us here on this happy occasion. First up, happy Diwali to you, your loved ones, your family, your team. Really appreciate your time here this morning. Just want to start with this RBL Bank bid, Jakes, if you have any thoughts. And it's not just RBL. There's two or three have happened before RBL, and perhaps more on their way. What do you make of it?
Well, happy Diwali for starters, and wish everyone, the viewers, the very best, and including everyone at CNBC. As far as RBL is concerned, actually, more from a thesis perspective, in several of my interviews in the past, year or thereabouts, we have talked about how when the first sign of new FDI comes in, the first sector it will and should and has been seen empirically where it comes through is in the BFSI space. The financial services space, especially banking, if allowed to attract capital, can attract serious amounts of it. We saw the Yes Bank transaction, and then we've talked about the IDBI divestment. Clearly, RBL as a mid-sized private sector bank, small to mid-sized, was in a sense ripe for the taking as any external person would have looked at. So the opportunity has always been there. And from a bank perspective specifically, they've done a hell of a lot in terms of cleaning out the issues of the past. Legacy has been cleaned up. They have guided for improvements as their portfolio has changed. They've guided for an ROA of 1% at the end of the year. So they've done, in a sense, the corrective stuff. The stock has responded to that over the last 1 year. It's been one of the best performing stocks in that mid-cap space, or in fact in the banking space itself, especially from the lows. The transaction itself gives it the much needed league shift, if you will, from a small to mid-sized bank to be able to have 40 to 43,000 crores of capital means that you are now rubbing shoulders with, if not the top four, but the next of kin, which means if you leave out the big four private sector banks, the next of them will contain RBL as one bank, especially with the kind of net worth they will have post this transaction. So a cost reduction, B, in terms of credit rating, C, in terms of pivoting business. I think commentary will now focus on how they pivot to be able to utilize this capital and grow their balance sheet from the current 1 lakh crores to maybe 2.5, 3 lakh crores over the next 3 to 4 years.
Yeah.
That is going to be the commentary people will watch out for. It's a landmark transaction, and it tells you clearly that there is capital waiting to come in, especially in the space that we talked about.
Yeah, no, absolutely. And large capital, right? And it's a control transaction. That's what's interesting. We've seen 10, 15% kind of, but this is 60%. So it becomes a subsidiary of Emirates NBD. And so in a way, a new chapter, new leaf, whatever you want to call it. Sandeep Bhatia is also with us, Managing Director and Head of Equity India at Macquarie. Sandeep, great to have you with us here. Thanks very much. Happy Diwali to you, your team, your family. Appreciate your time as always. RBL, if you have any specific thoughts, but the broader question is financials. Financials were top of the list in terms of what will do well if one asked that question a year and a half back. But then, of course, they didn't do very much. But looks like stars are aligning, stars are coming up in a row. All the measures on the tax front, easing front, and now, of course, some of these large deals coming into being as well. What do you make of it, Sandeep?
So, very happy Diwali and New Year for the entire CNBC team and everyone and loved ones of the viewers. I think the finance sector has always been cheap, so there's always a lot of interest because valuations compared to the rest of the market has been good. It's also a sector which is very liquid, has large exposure both from domestic institutions and foreign institutions. So it's mostly a default position. I think what happened in the current somewhat which just went by, we saw essentially the impact of low growth, no lending growth. With the GST rate cuts and with now, I think definitely more optimism in terms of consumer spend in the broader economy. I think volume growth, or which is for banks, loan growth will definitely come back. Margins and quality of book remains good. So all that means that some of the large private sector banks are in a good position. We have to be careful about transactions and deals. While this is definitely a welcome transaction, I think it essentially speaks about the opportunity in the sector rather than the quality of the specific bank. And that is something which we need to be aware of. I think also the fact that, a lot of Middle Eastern banks are not definitely the best managed. I think most Indian private sector banks over long periods of time have seen, at least top 3 banks have seen better management than most of the Middle East banking sector. So to that extent, I'll just say that this is a positive investment and also a strategic direction of the relationship that UAE and India have. So yeah, it's welcome, but there are better banks and cheaper banks over the longer term.
Sandeep, hi. Season's greetings to you. Wish you and, all your near and dear ones a very, very happy Diwali. And kudos because you had called out the financial space. I remember in an early September conversation, you said that banks do look interesting. And, they could perhaps start, performing well. And look at it, I mean, the numbers are really coming through. So the question is whether one should buy the whole basket. I mean, you can simply buy the Nifty financials, the Nifty bank. But what would be your pecking order between, say, large NBFCs, large banks, mid-sized banks, or an opportunity, I mean, some of the mid-sized ones, including RBL, the kind of transition that they're going through, or, say, IndusInd Bank, which some can argue can be a turnaround story. So what should the strategy on lenders be for an investor?
Very good question. So I think in terms of, let's say, IndusInd Bank, I heard the call, and I think we have a good management now in place, but it may take some time. So any buyer of IndusInd Bank should have at least a 2 to 3 year time frame. It will require the whole new team which is coming in to make significant changes. We'll have to see how that affects morale and organization, internal organization dynamics. Any big change is definitely painful for the employees. So we have to ensure that this management is able to take everyone along who's part of the bank. So that's a more long-term call, but definitely that's worth looking at. I think in terms of the basket of stocks, I would think if we see a broader push in the economy, the public sector banks and the top 3 private sector banks are beneficiary, and therefore these are the baskets of stocks that you should look at.
Okay, so look at a basket of financials, and very quickly, Sandeep. Again, last time we spoke, you said the market is still in a slow burn phase, quote unquote. So what's the phase? Has the burn gotten over? Is it now a brighter shade?
Definitely right now with Diwali and everything which has happened post GST, it's a brighter shade. I would say that this Samvat year should see better returns than last Samvat year, which has been flat to negative mostly, depending on your point of entry. But I would still be cautious to the extent that if we see a big run-up, we have seen some froth come through in the IPO markets. So there's definitely significant flows which are coming into Indian equities from domestic savers and domestic institutions. So if there's froth and if we see the market run up 15 to 20% from here till Jan, then definitely again the market goes into the same slow burn phase that we discussed some time back. It's a 10 to 12% return market. It's not a 20%, 25% return market. We should be aware of that.
Okay, all right. I got that. Sandeep, Jakes, final word from you. Next 1 year, what do you think? We should be happy with high single-digit, low double-digit returns or a flattish year? We've gone through the grind. It's been a tricky wicket in the last 1 year or so, but we pull through, right? We're bracing for better times, and also private banks is what you like. What about metals?
I think metals would be beneficiaries because I think China has moved towards curbing production in several cases, number one. And number two, in general, if we have a weak dollar scenario, which may have periodic sort of reversions to mean kind of movements, but in general, if the movement is one of, I think what we've seen recently in terms of both currency movements and commodities, especially precious metals, may have been a bit of an excess. So there could be some reversion to mean. I think even the Indian rupee could be at these levels an attractive entry point. In fact, I think at about 88.5, 89, it may have peaked out in the short run. So keeping that in mind, and with oil being low, which is the big sort of tailwind for India, my assessment is we may be happy with 8-9% returns is one way to put it, but we could end up getting much more than that.
Okay, well, we hope for the best and hope the next 12 months are brighter and sort of they glitter more than the patience that the last Samvat has demanded of investors. Thank you, gentlemen, very much for joining in, and once again wish you both a very, very happy Diwali. Well, that's the market conversation on the day of Diwali, and the market's actually in cruise control mode, almost 200 points higher up and chugging along. I'm looking at a couple of corporate reactions now, and let's pull up Dixon. Dixon is down just about 0.25%. Numbers, of course, came in over the weekend. So let's go over some of the key questions that we have for the guests. We have Saurabh Gupta. Director of Finance at Dixon, joining in for a conversation. And some of the key points that the market also, is putting the spotlight on. Number one, the outlook for the mobile segment, because there is an argument out there that, the growth is not as much as what the management was guiding or the market had in mind. Then, of course, we need to understand how the new JVs are shaping up, both Vivo and HKC. And, of course, new clients and new growth levers that the company is looking at for the rest of the year and, of course, going into the new year as well. Saurabh, thank you so much for joining in. Season's greetings to you. First of all, wish you, everybody at Dixon and, everyone at home a very, very happy Diwali. It's been a steady quarter. But allow me to ask you this, because, the guidance on the mobile, mobile phone volume side was about 15% growth. I think you've done about 13%. And in the market, the chatter has been all about Motorola, which is your big client, largest client, and the deceleration that's happening in the Motorola business. So just shed some light on it, and if you could assuage these concerns on the mobile phone volume.
Yeah, good morning and wishing all of you and the entire CNBC team a very happy Diwali. Yeah, so my sense is we had projected a volume, budgeted a volume of almost 40 million mobile phones for this year, smartphones for this year. I think so we are on track for that. And the first 6 months we have done broadly 20 odd million. Yeah, within the customers, so we pretty much work with all the customers on the Android ecosystem. Yeah, within the customers, there can be some plus minuses, but broadly we are working towards achieving that 40 million number for this year and hopefully 65 million number for next financial year.
All right. Hi, Mr. Gupta. Good morning. Festive cheer to you as well as the family and all at Dixon. Give us a few more details. How much of volumes would Longcheer contribute in the coming year? And also, do you see a higher amount of volume shift into the JV from Longcheer?
Yeah, so Nigel, our JV should be operational by somewhere around April 26. We have taken a new facility in Noida, and we are expecting closer to 9 to 10 million volumes. There can be upside to those volumes, but yeah, the business plan is getting worked out. But yeah, 9 to 10 million is something that we are absolutely confident about for next financial year.
Got it. Focusing on volumes itself, so 40 million for this year, which goes to 60 million. Out of that, the Longcheer JV will contribute around 9 million. Exports will contribute how much?
Around 65 million is what we are looking at.
Next year, 65 million. How much will exports contribute both in this year as well as next?
So the first 3 months we did an export of 2.8 million this year. Last year we were at a very small number. So definitely the export numbers have grown. And hopefully in the next 6 months also the numbers should grow for exports. So my sense is out of that 65 million, broadly 8 to 10 million can come from exports, if not more.
Saurabh, hi, morning. Happy Diwali. And I think it's a happy Diwali, especially for you as well, right? Congratulations. I think you get onto the board of Dixon, Saurabh?
That's right. Yeah, I just been appointed as a director on the board. Yeah, thank you so much, Prashant. Thank you.
Lovely, lovely. Onwards and upwards, as they say. What about margins, if you will, across businesses? I think you've seen some expansion. So mobile and EMS, consumer electronics, home appliances, all have seen anything between 10 to 40 basis point expansion in margins. Could you provide us with some amount of guidance, if you can? How will this trend from here?
Yeah, so Prashant, we are broadly at 3.7, 3.8% in the first 6 months. My sense is that should be the run rate for the going 6 months as well. So broadly, we should land up at a similar number for this financial year. But with more backward integration play, I think so the backward integration play should continue to add to our margins. Our expansion in the refrigerator portfolio should add to the margin profile and overall the operating leverage benefit. So my sense is next year, because of this largely on account of this backward integration play, we think we can expand the margins anywhere between 50 to 60 bips. And a large part of that margin expansion will happen in 27-28. Because by that time, a large part of a backward integration play, especially in mobiles and IT hardware, would have been completely ramped up and stabilized. So we are looking for a good margin expansion in 27-28.
So FY28, I mean, this backward integration we've spoken about earlier as well. So should be between, what could be the range? Could we by then see a 80 to 100 basis point bump to margins from where we are?
Yeah, so broadly, our numbers indicate that it can be 100 to 120 pips margin expansion in 27-28. And part of which, half of it should get reflected broadly in 26-27.
Saurabh, let's talk about the joint ventures as well, particularly the ones that you are getting into with Chinese entities. So the market's eagerly awaiting on the latest with HKC. You're making, I think, display modules with them. There's Vivo as well. Just update us. I mean, have all the permissions and approvals come through? When do these go off the ground? And then I'll come to the the other alliances that you're looking at. But just an update on Vivo and HKC in particular.
Yeah, so it's progressing very well. There has been a lot of back forth on answering the various queries of the various ministries. And we feel confident that the approval should come in the month of November, in the coming weeks. So we are absolutely geared up for that. And yeah, we plan to consolidate hopefully our numbers from Vivo, hopefully in Q4. And yeah, HKC, yeah, the construction is happening. The machines will be installed by end of December. The trials will happen in Q4 of this fiscal, and the mass production will happen in Q1. So we are absolutely on track. Our acquisition of QTech happened on 26th of September. So we started consolidating the financials. So that would already start to play out in Q3 and Q4. And we'll continue to deepen the level of manufacturing, expand our margin, expand the capacities, and also take advantage of the component PLI scheme.
Okay. All right. And just very quickly, 10 seconds. Overall top line growth for this year, and just give us the revenue mix. What will it be? And whether there'll be any pickup in your consumer electronics business, which obviously has been sluggish.
So yeah, consumer electronics is sluggish because the TV demand was really muted in this quarter, mainly on account of this postponement of purchases on account of the GST announcements. Hopefully, we should be able to recoup some of that in Q3. Yeah, my sense is the overall revenue guidance, I would say, should be closer to 30-35% for this year. But definitely, we are looking for almost a large growth for next financial year. So between 24-25 and 26-27, we should be broadly able to double our revenues.
All right. And profitability, last year it was around 700 crores, which was double of the previous year. You're a 1 lakh crore market capitalization. Most on the street are anticipating by FY28, you'll do 2,200 crores of PAT. Is that possible? 700 crores last year goes to around 2,200 crores.
Yes, it should be in that range, Nigel, broadly, yes. Yeah.
All right, Mr. Gupta, thanks a lot for joining you. Have a good Diwali. For the timing, the stock looks expensive, but maybe on a forward basis, if you do that 2,200 crores, then it's at around that 45, 46 times odd, which is relatively less expensive. Appreciate you joining in. That said, let's shift focus to JSW Steel then. Mr. Jayant Acharya, the Joint Managing Director and CEO of the company, joins us on the show. Hi, Mr. Acharya. Thanks a lot for joining in. And it appears your subsidiaries actually have done very, very well. So first, let's focus on demand. What are the trends you're seeing on the industry at current reckoning?
Demand has been, fairly strong. We saw an 8.9% growth in the Q2. This is on the back of a larger base, let's say, over the last few years. So demand continues to be strong in spite of a seasonally, weaker quarter, let's say, and a prolonged monsoon. Second half, I would say the demand will be better. Post the implementation of the new GST rates, the sentiments have turned quite positive. We see economic activity and buying across multiple segments. So I think the consumption story will really pick up post this because we have interest lower. We have the benefit of lower inflation. We have the benefit of lower income tax, and on top of that, the GST. So all combined, I think, will spur consumption in a good way as we go forward.
All right. What about demand? Demand's strong, right? As you're saying. But what about the scope of going ahead and increasing prices? There's a big gap, if I look at it, between domestic pricing and the landed cost of imports.
So, one is that it's a seasonally weaker quarter. Secondly, the fact that the supply which came in terms of the production was a little lumpy, let's say, from the domestic producers. So that production, I think, was a little bit more during these last few months. But by and large, now we see that absorbed. Pricing, we feel in the monsoon quarter has now more or less stabilized. Between November to December, we should see a price improvement on the back of a better demand, better consumption. And as you said very rightly, there is a discount to import prices. So all in all, a seasonally stronger H2 will see improved prices going forward.
Okay, all right. Coking coal cost will move up a little bit, if you look at it on a quarter-quarter basis. But directionally, since operating leverage, higher prices as well will play out, do you think the EBITDA number can actually improve?
So if you were to look at the outlook, so one, reiterating that the volumes will be better. We already had good volume numbers, as you saw in quarter two. Going into quarter three and quarter four, we are seeing that Dolby has ramped up well, BPSL has ramped up well, and JVML now I think will be able to deliver, let's say, the full capacity now in the second half. So volumes will be better. Demand is likely to be better for the second half. Pricing, as I said, between November to December should improve. On the cost position side, we should be able to mitigate the impact of the coking coal cost through efficiencies. However, that said, also keep in mind that we have taken one of our blast furnaces in Vijayanagar for a shutdown for expansion of the capacity by 1.5 million tons. And that's for a period of about 150 days. So there'll be some shutdown related impact cost, which would come in. But other than that, on an operational parameter point of view, I think we'll be range bound on cost. The benefit which could come is on the raw material side would be iron ore, because iron ore prices have been elevated in India. And internationally as well, we expect a reduction in the iron ore prices in the coming quarter, in the October-December quarter. So that should be positive.
Okay, what about international operations? How is the US as well as Europe shaping up? Europe, in fact, it looked pretty good for the last quarter.
Italy has done well last quarter. The rail shipments were better, the rail volumes were better. We expect Italy to be operating in a stable environment for the next half as well. As far as US operations are concerned, the volumes, the utilization of capacities were better. From a margin perspective, I think it has been similar, except for the fact that there was a pipe order which slipped into the next quarter, due to which you will see in print a lower EBITDA number. But otherwise, Baytown and Ohio put together, we have done about $12.2 million dollars of EBITDA in the last quarter. So overseas, if I look at Italy and US put together, I think our operations have done reasonably well, and we should be able to have similar kind of growth in the second half as well. Only one thing I would just like to highlight is that we have the expansions in Ohio kicking in during this second half. So there will be a shutdown for a period of time to implement that particular equipment, so that there will be some impact on the volume. Other than that, we'll be fine.
Very quickly, Mr. Acharya, before we let you go, China is talking about this anti-involution policy. Your reading of the same, and have you seen some evidence on ground? Chinese are reducing production?
Yeah, so China involution policy is a big positive. We are seeing moderation already, which has taken place in the first few months. We should see a 30 to 35 million ton reduction in the Chinese steel production in this calendar year. And going forward into the next year, you will see some moderation further as well. So that is good for the world at large. We are expecting that the exports from China next year hopefully should moderate. The domestic production, the domestic consumption has also softened. Although I think majorly the housing sector has been weak, but it's been made up to some extent by better manufacturing, better automotive, and some infrastructure investments which they have improved on. So I think the domestic consumption should improve with the Chinese economic push which is being given. Production is coming down, and that should reduce exports, which augurs well for the industry at large.
Thanks a lot, Mr. Acharya, for joining in and giving us an outlook with regard to the second half of the year. Chinese reducing production. That's going to be the greatest news, I think, both for their industry and the global steel industry as well. Thanks a lot. Well, we'll slip into a short break. On the other side, we'll connect with the management of IDFC Bank to detail their quarter numbers. Stay with us.
Welcome back. So we're staying with earnings, and there are so many of them that have come through the weekend. And the next, stock and the next bank on our radar is IDFC First Bank. So let's look at, some of the key indicators and, of course, the key questions that we have for the management. Mr. I think, we have Mr. V. Vaidyanathan joining in right now. Some of the points that the street would want clarity on would include, of course, the net interest margin picture. Can there be an expectation of better NIMs in the second half of the year? That's point number one. The bank has reported a very robust loan growth, 20% robust loan growth. So is that likely to sustain? And of course, we want to understand their ROA targets as well going forward. Mr. Vaidyanathan, thanks for joining in. First of all, season's greetings to you. Wish you, the team at IDFC First, and everybody back at home as well, a very, very happy and joyful Diwali. So let's start with the first point, that of course this quarter there's been a bit of a NIM compression, but in general the sense is that as that CRR cut kicks in, as loan growth picks up, NIMs in the second half, the overall financial system are expected to increase. Is that the view that you have for IDFC First as well?
Yes, this quarter we passed on the full impact of the repo rate cut that RBI had done to our customers. So that brought down the NIM to 5.59%. It is down 12 basis points. Q3 and Q4, we expect the net interest margin to actually improve. That's because our cost of funds is coming down and we expect it to come down.
Can you elaborate on that, Mr. Vaidyanathan? I mean, what sort of an improvement and how is this cost of funds coming down? What's taking it lower? What's your mix looking like now?
Basically, we brought down the fixed deposit rate quite sharply by about 100 basis points. So, and the fixed deposit rate usually takes about 1 year to about 15 months to fully pass on because that's a typical tenor of fixed deposit. They come for repricing. Whenever they reprice them at a lower rate. So that is already brought down our cost of funds last quarter quite substantially. We expect it to further come down next quarter, further come down quarter after that. In fact, we are really thinking that for the first time in the bank's history, by Q4 of this year, our cost of funds will go to below 6%. We are very, very happy about that. And to mind you, we started at 7.8%. So that is already 160 basis points cut, another 20 basis point cut in the offing.
So by the time we end the fiscal, NIMs should go back up to sort of what sort of a zone? Closer back towards, go on.
Upwards of about, today it's like 5.59. Definitely should go to like 5.8% or so is the number we are broadly working towards.
Okay, all right. Hi, Mr. Vaidyanathan. Always good to have you on the show, sir. Nigel on this side, wishing you, your team, a very, very happy Diwali and all at home as well. I wanted 2 numbers from you, sir. One is on the credit cost guidance. You've been guiding for better times ahead. So tell us what's the outlook out there. How do you see this credit cost number coming down? And the ROAs as well. As the year progresses, you're saying that it gradually moves up. So give us the targeted number with the timelines.
So let's take one thing at a time. Let's focus on credit cost. So even now, if you take out, microfinance is an industry issue. It happened to everybody. So ex-MFI, we're still in the zone of like 2.05%. We are guiding for the end of the year. And by the way, just to mind you, it is of percentage of loans. If you take it as percentage of assets, it's like 1.4 something percent. So of assets, meaning the whole assets. So coming back to the point, so it's already come down. It's like in that zone for the full year. Why it should come down to your question? Because the impact of microfinance is like going away. Q3, Q4, we expect very low credit cost in microfinance. So that's the reason why credit cost in H2 should be better, like much better than what it was in H1. And therefore, the whole year should look good and we'll have a strong closing to the year, I'd say.
All right, just come back to the ROA number. You had said, I think, that it heads towards the 1% mark, right? You're holding on to that.
The ROA front, yes, of course, our bank, why one? We should go past 1.5% also in due course as the bank builds out. As of now, obviously when cost of funds comes down, net interest margin goes up. It should and credit cost also should come down. These are the numbers we're putting out. So naturally, we should see improvement in ROA, and we are more shooting towards 27 there we definitely feel that we will be in a very strong position. And between 19 to 24, we saw a strong turnaround of the bank, and that profit really took off. We almost get the feeling, I hope we come right, but we almost get the feeling that between this year to the next 4-5 years, we do get that feel about the bank.
So 1% not by the end of this fiscal, is that correct? Now it'll be sometime in FY27.
27 certainly, but the end of the year we'll see where it goes. The direction should be definitely trending in the direction. Now, whether it exactly touches 110, 100 basis point, 1 or maybe 0.9 or 0.8. It's very hard to pick a number specifically on these things because there are so many moving parts. That's why I always focus on direction. I always focus on building the big blocks right: credit deposit ratio, borrowing, the capital. So we look at the big block items, and these things will fall in place. I can't pick a specific decimal, but direction is definitely good.
Mr. Vaidyanathan, let's talk about the loan growth as well. I mean, 20%. That's it's quite remarkable, right? So, is this the kind of number that you think you'll do for the full year? And also qualitatively, where's the confidence coming from, or the comfort coming from? Which are the segments where you're really seeing demand for credit pickup?
You can see now how the GST cut has really lifted off the game, and you've seen the numbers that have come from consumer durable companies, two-wheeler companies, car companies, consumption companies. So this is a big thing, and you see, if you notice, different players are placed in different parts of the ecosystem. Our bank is basically very indexed to the MSME growth. We are seeing good credit growth there. If you see, India's credit growth is only maybe 10 or 11, but if you see MSME credit growth is like 18-20%. So we are there in that space, which is growing. The consumption business, which is all the durables and laptops and washing machine and refrigerator, we have developed really good capability. We are in that space that should grow. So we happen to be in areas which are the growth markets. It's just the sectors itself we are present is growing more, and corporate segment we are less indexed to. So that should, the fact that corporate credit is not growing very much shouldn't bother us very much.
Right. Mr. Vaidyanathan, good morning. Consumer loans, MSME is one area. The other is consumer loans, where this GST cuts, etc., were supposed to show up in a big way. And we're getting some feedback that it is showing up. Could you give us some sense of how big a lift this segment is getting or is seeing in your bank, sir?
The numbers in the public domain, right? Where different research houses, including SBI, IDFC, everybody's put out that consumption growth in the country, because of GST factor alone, is expected to lift by about 2 lakh crores. And we happen to be in that space, like I said before. That's one reason. Of course, the interest rates that came down, income tax that came down, all that put cash in the pocket, we know all that. The thing, if you see, since you asked specifically for us, where is our growth coming from? We are growing the loan book by about, let me call it, about 50,000 crores a year, but or in that zone, maybe 45 to 50. And 90% of this growth is coming from 4 areas. One is mortgages. That's growing by about 7,500 crores. Second is vehicle financing. That's growing by about 6,500 crores. Third is consumer financing. We talked about all those products there earlier. So that is about 6,000 crores. And then business financing, which is a small business, large business, even corporate banking, that's about 20,000 crores. So if you add these 4 numbers put together, you'll find 90% of our growth is coming from these 4 lines of businesses.
That's very, very helpful, Mr. Vaidyanathan. We'll leave it there, and we'll do a status check maybe in a month's time when you have a sense of how the festive season, and of course this is one of the best periods for financial institutions, for consumer spending, etc., as well, seasonally, because of festivals. So we'll do that. Thank you very much for joining us once again. Season's greetings and happy Diwali to you from all of us.
From all of us as well, to everybody and your viewers. And I must say that last year and a half or so went away talking about microfinance, this, that, book coming down, yield coming down, all that. It's taken away about a year and a half of our income lines, and that's why you saw profits are muted. I can safely say that next quarter after that, in 27, 28, 29, we see almost the same zone of growth coming back in profitability because the credit costs coming down and margins improving. So you should look forward for better days from IDFC.
Absolutely. And we certainly hope so. And we look forward to reporting on those better days and speaking to you as well. Thank you very much once again. Appreciate it. All right. Well, it's financials and banks in focus, one after the other. So let me now welcome in the management of Federal Bank, which has reported a pretty good set of results. Mr. Venkatraman Venkateswaran is Executive Director at Federal Bank. He's joining us now to talk about earnings. And we'll talk about a couple of things, right? So just want to put out and tease out what we'll talk about. Loan growth pickup from here, margin expansion and whether it will sustain, credit costs, whether they will go down from here or not. Sir, good morning. Welcome to the program. Thank you very much for joining us. Prashant this side. First up is, it's season's greetings and happy Diwali to you, your team, your loved ones, from all of us here at CNBC-TV18.
Thank you. Good morning, Prashant, and happy Diwali to all the viewers.
Mr. Venkateswaran, if I may, and please, if you will allow me, actually, before we get to earnings and guidance there, so over the weekend, this big deal came in, right? Emirates NBD picking up 60, when the deal gets them to 60% in RBL Bank, $3 billion infusion. What we understand, what we pick up, and there's a fair bit of chatter around, is that there is a transaction brewing in Federal Bank as well. Can you confirm if something is imminent, sir?
Prashant, I read about the Emirates NBD deal as well when it came out in the public domain. And in our case, we have given a notice of our board meeting on Friday.
24th.
And we will update you once the board meeting is over.
Okay.
But sir, can you?
Can I just, if I can, without of course divulging details and not wanting you to say anything which is against regulations or anything, but is this a minority transaction? The name which is, of course, being talked about is Blackstone picking up a 10% kind of a stake in the bank. Would I be, without you going into specific, in the ballpark, be correct?
Prashant, as I said, the board will be meeting on Friday to consider this agenda item as we have put up in the exchange. And please let us time till Friday, and after the meeting, whatever is the outcome, we'll give you an update.
But sir, can you, we understand you can't take any specific names, but I believe the bank is already well capitalized. Can you just update us on the latest capital adequacy levels? And also, why are you looking to raise capital? Is this just an enabling resolution? Or are you looking to, maybe expand in certain businesses, wealth, etc.? I mean, why the need to look at capital at all right now?
Surabhi, good morning to you as well. Like I said, I'll just repeat, just bear with us till Friday. Once the board meeting is over, then we definitely come out and give you an update on the outcome of the meeting.
This is a minority transaction, right? That much you can tell us.
I don't even know what transaction you're referring to. All that I said, the board is meeting on Friday on the agenda, which we have put up a notice on. And we will, as I said, we will definitely come back and give an update on the outcome of the board meeting.
All right. So in the past, you have said that wealth management is something that you like to look at. Possibly that you're looking at some inorganic growth in this direction?
Nigel, good morning to you.
Morning, sir.
On wealth management, Nigel, as you know, we have recruited a head of wealth management who joined us earlier this financial year. And we are building out our platform for launch of the organic offering of wealth to our customers, which is on track. And, in Q3, next quarter, or rather this quarter as we speak, we will have the rollout of the wealth offering to our customers. So that is on track. And, we do, of course, want to grow as part of our strategic objective, which we had outlined in the analyst meet. Wealth is a focus area and the organic rollout is on the cards.
And what about inorganic growth, sir?
Nothing on the table at this stage, Nigel.
So the money that you're raising could probably be used for some other inorganic growth?
I don't want to comment on this aspect. As I said, let's wait till Friday and then we can talk more on.
But it's not just an enabling resolution. The intent is to go ahead and raise money, right?
The board will consider all options, and we'll have to respect the wisdom of the board.
Okay, let's focus on business then. We tried. I mean, went over the wicket, round the wicket, also bowled a couple of dusras, but we'll wait till Friday, as you told us. Let's focus on business. What's the loan growth outlook? What kind of NIMs are you looking at, in the coming year? Tell us how's the trajectory panning out.
On NIMs, Nigel, as you had seen, we had a very strong quarter in terms of NIM growth from 2.94 to 3.06, completely driven by the fact that the cost of funds dropped by 22 bips and yield on advances dropped by 14 bips. So a large part, 8 bips came from there, another 1 bip from CRR cut, and the balance was on balance sheet optimization. So completely no one-offs in that, very strong growth. And I'll touch upon the advances in a minute. And what you also see is the fact that the NIMs was helped by actions which we took on both sides of the balance sheet, both liabilities and on the asset side. We do expect to see the NIM improvement trajectory to continue in the coming quarters as well. On the advances, whilst the overall advances may look like a high single digit, but one needs to go beyond what is there in terms of seeing we have grown very, very strongly on all the chosen segments which we had outlined earlier. The mid-yielding segment where we have commercial banking grow 7% QOQ, CVC 4%, gold, whilst the headline says retail, overall gold grew 3%, retail gold actually grew 7% QOQ. And cards grew close to 4.5%. So very strong growth in all these areas. And to add to that, the two other medium-yielding segments, LAP and business banking, both which had shown a degrowth last quarter, has turned the corner, have grown, albeit 2% and 1.5%. But we expect to see those two segments also coming back very strongly. So overall, on the asset side growth, on the chosen segments, extremely strong growth. And we do expect to see that continue, the momentum continue.
But just a follow-up on the 2 points that Nigel raised, sir. Your largest segment, retail, that was up just, I think, 1.5%. Why such sluggishness there? I mean, are you expecting it to improve? So what would be the total loan growth for the year? And you said NIMs are expected to keep improving. If you could give us some range, I mean, what would the exit expectation be by the time the year ends?
Sure. See, I think, again, coming back to the overall growth number which you mentioned for retail, you should understand that in our balance sheet, nearly 50% of advances is in home loan and corporate. And these are the two segments which contribute the least at this stage to the margins. So even if they grow at a particular percentage lesser than the chosen segments, the overall numbers may look muted in terms of growth. But what you should look at is, it's about profitable growth. And are we getting the returns commensurate to the risk which we are taking? Are we growing in the chosen areas which we have chosen to grow? And to your question about how the NIMs will look going forward, I don't want to give a number in terms of guidance, but I can tell you that the growth trajectory on NIMs will continue to be strong. We obviously want to grow the NIMs from the current levels. And let's take it one quarter at a time, because there is also the news of or the expectation of a rate cut around the corner. So we'll have to see how that plays out as well.
All right. We'll leave it there, Mr. Venkateswaran. Appreciate you. A couple of more questions, but out of time. And we wish you all the best of luck. Thank you very much, and look forward to speaking to you post-Friday, in terms of what you announce. As far as that fundraise exercise is concerned, shape, form, etc. I hope we'll have the opportunity to be able to do that right out of that board meeting. Thank you very much.
Sure, Prashant. Thank you. Bye.
Thank you. What we'll do is take a quick commercial break here. Markets, of course, have come off. We were up about 200 points. We're up 100. So there is a bit of a drop-off which has happened. Across these precious metal ETFs, both silver and gold ETFs, there is a sharp drop-off between 6, 7, 8%. Drop-off coming through here. Market breadth is slightly negative, 1,100 higher, and about 1,700 stocks are lower. But lots of single stocks with huge volumes on the upside. We'll talk about some of them in a bit. Commodities in focus on the other side. Manisha will come on in just a bit. Stay tuned.
Welcome back. So there's still some green on the screen as far as the equity market is concerned. Let's find out if the commodity market continues to sparkle as it has. Let's take it across to Manisha for the latest. Manisha, happy Diwali. What's sparkling today?
Well, almost everything. You know, the way the year has been, we've seen very, very strong gains continuing in for gold and silver and for various other commodities as well. But I want to start with gold on how those prices have been on a Diwali to Diwali basis. So when you look at 2021, and that's where I'm taking this chart from, you saw the prices gain up by just about 3,000 in that year, and then 9,000 the next year, and then nearly 18,000 the next year. And now when you look at the prices, it's almost a 55,000 rupees of a gain. So every year we've seen those gains continue to double from a Diwali to Diwali basis. Coming on with the silver prices in a similar way. So from 21 to 22, we actually saw the prices decline by nearly 6,000 rupees. But then after that, you've seen nearly a 13,000 of a jump up and a further, and 94,000 to 1,60,000 has been almost like a 75,000 rupees of a gain in the last 1 year that we've seen in case of the silver prices. So very, very happy, bright, shining Diwali is what you have when it comes to gold and silver. When it comes to other commodities, well, can't say the same because I want to start with energy here, and crude prices have declined by 18% in this year. Well, it's great news really for India, which is a major consuming and importing country. Coal prices have declined further by nearly 29% in last 1 year. Take a look at the metal prices now, and within this as well, it has been the best of gains that we have seen for palladium, 41% of gains. Platinum has gained up by nearly 60% in last 1 year. And then come to the base metal prices because copper is up by nearly 15% in last 1 year. Aluminum has gained up by 6%, and that's exactly where the gains kind of stop when it comes to metal prices. Because when you look at steel, iron ore, zinc, well, we are trading flat to slightly negative for many of those there. Agriculture commodities should be very interesting to take a look at as well, because when you look at coffee, and that is the major gainer in last 1 year, when you look at agriculture as a space, 55% of gains coming in there. Edible oil sector has seen 5% of a jump up, and that's where exactly the gains stop. Because when you look at essential commodities, remember, inflation has been quite kind there. You're looking at wheat prices down by 11%. Sugar is down a huge 30% in last 1 year. We're looking at excess supplies in major producing countries like Brazil, Indonesia, and Thailand, etc. And then you have rice, which is down by 29%, cacao down by 20% as well, and cotton, rubber, which are seen as industrial agriculture commodities, also have continued to decline anywhere between 11 to 14% there. So when it comes to agriculture commodities, well, we have seen kinder inflation. When it comes to safe haven metals, we are looking at gold and silver continuing to shine bright with expectation that next Diwali could be even higher prices from here on. Hey, guys.
Hey. Well, we have the full splendor and the might and the glitter and the sparkle of Team CNBC TV18 right here with us. So, guys,
I think we should do a countdown, right? So all of us wishing Happy Diwali together. So 3, 2, 1, guys, go.
Happy Diwali!
That was good.
Yeah.
Welcome back. Well, we still have earnings to look at despite the Diwali color that you saw on screen. The earnings continue with banks. Actually, Bank of India's second quarter numbers are in focus. Net interest margin is under pressure like it is for all banks, but loan growth is excellent at 14%. Joining us now is Rajneesh Karnatak, the Managing Director and CEO at Bank of India. Good morning, Mr. Karnatak, and season's greetings. Happy Diwali to you and to everyone at Bank of India and your families. Well, let me start with the margins itself. Yes, 14 basis down. We are seeing that on an average it's been 12 to 14, though some banks have been able to beat it. Do you recover from this level in Q3 itself, or will it take one more quarter?
Yeah, good morning, Lataji. Thank you so much for having me here. A very happy Diwali to you, to entire CNBC TV18 team, and also to your viewers.
Thank you.
So as you rightly said that, yes, NIMs are under pressure and our NIMs have dipped and we have closed the global NIM at 2.55%. However, if you see our domestic NIM, they are much better at somewhere around 2.86. As far as the going forward NIMs are concerned for Q3, we think that it should be improvement, because whatever the repricing had to happen in the credit side has happened in the Q2 quarter, because the last cut, as you remember, has happened in the month of June 25, and the entire cut has been taken up in the quarter of Q2. As regards the repricing on the liability side, some repricing is yet to take place, and we feel that the entire repricing would happen in the Q3. So we should see a better uptick as far as the net interest income is concerned from the Q4 quarter.
Even if there is a rate cut in December, which some people are expecting because the October inflation is likely to be 0.5% or even lower. So, even the governor said that there is space to support growth. If there is a rate cut in December, will you still be able to post a slightly higher margin? Because your overall guidance is 2.6, right, for the full year?
Yes. So let me clarify that, first of all, we would not speculate on the rate cut from the RBI side. Yeah. Considering the fact that the inflation is under control, retail inflation is on a lower side, there is an expectation for that. But if the rate cut does happen, definitely it will impact the net interest income for all the banks, because obviously the 63% of our book for Bank of India is external benchmark, which is linked to the repo. So there will be some impact, definitely.
But are you confident of 2.6% for the full year margins? That's your guidance, right?
Yeah, that is our guidance at present, considering the fact that, assuming that there is no further rate cut.
Okay. Oh, okay. So we will have to take it as it comes. Mr. Karnatak, what is your sense about asset quality? You have a decent 16% rise in margin in MSME loans. Your overall exposure to agriculture is 20% of your adjusted net bank credit, which is, the priority sector requires 18%, you have 20%. Are you worried about, any loan deterioration? How is your SMA1 and SMA2?
Yeah. So as far as the asset quality is concerned, if you see our results, Lataji, that we have a very good asset quality in the Q2, and our fresh slippage was only 895 crores. And if you see the slippage ratio also, it is at 0.14 only. And we have improved our slippage ratio. Our gross NPA and net NPA has come down. Our gross NPA is now only 18,000 crores. Our net NPA is somewhere around 4,000 crores. And in percentage terms also, our gross NPA is 0.65, 2.65. And the net NPA is also at 0.55. So we are improving as far as the asset quality is concerned. As regards our SMA numbers, there also, if you see 5 crore and above that we have published, so there our figure was around 7,000 crore in Q2, which is now at around 6,000 crore in Q2, which was around 8,000 crores, which was there in Q1. So there also we have improved. And as far as the SMA above 5 CR is concerned, it is now below 1% of our global loan book, standard book. So there is an improvement in that, and SMA 1 and 2 is also not very high. As I said, the overall SMA number is within 1% of the standard book as on the Q2 of 25.
Got that. So no concerns at all. Your credit cost is really low at 0.28, and you think there is scope for it to go even lower, right? Okay, let me come to the loan growth once again.
Credit cost is low, Lataji, because of the fact that yeah, please go ahead.
Go ahead. No, go ahead, sir. Complete your credit cost argument.
Yeah, just wanted to give more clarity and color on this credit cost part. So credit cost is low, as you rightly said. That is also because of the fact that we have been able to contain our slippages in Q2. Since the slippages were below 900 crores, obviously the credit cost also has come down to 0.28%, which is lower than the 0.55, which was there in the Q1.
Okay. Loan growth, you have done 14%, but you're guiding only 12 to 13% for the full year. Will you surprise us on the upside? Are you guiding too conservatively?
Yeah. So loan growth has been 14%. You are right on a global side. On domestic side, in fact, it is much better. So if you see the domestic growth in the RAM segment, our agriculture has grown at 13%. Our MSME has grown at 16%. Our retail has grown at around 19%. And our RAM has grown at around 17% on a YOY basis. Even the corporate credit had grown in double digits in the domestic side at around 10%. So when we are saying the guidance of around 12 to 13%, yes, the guidance is conservative and we are fully confident that we'll be surpassing this guidance.
Okay.
Only thing is that because of some geopolitical issues which are there, the war issue and the tariff issue, we are just trying to give a guidance which is like 12 to 13%.
Oh, right. Got that. Let me come to the ECL. You must have done some internal calculations about expected credit loss. How long will you take? What may be the impact on the balance sheet and P&L in the first year, FY27?
So in the first year, FY 25-26, see, as you know, the guideline, only the draft guidelines has come out.
Yeah.
We are internally going through that. All banks are going through it. So what we know is that it is effective from 1st April 2027. There is a 5-year leeway which the RBI has given to all the banks. And there is a provision which is to be made for the stage 1, stage 2 and stage 3 assets. The ballpark calculation that we have done, that's a very preliminary estimate. That I can say that on the CRAR front, we see an impact of around 1% on the CRAR on an annualized basis. So 1% per annum, which means that around 5% in the 5 years. And as far as the clarity on the CRR is concerned, see, we have already done a net profit of around 4,800 crores in the half year. And this year, we are estimating in this financial year FY26 a net profit of around 10,000 crores. Given that fact, our CRAR will improve to that extent. And further, 1 percentage point of our Bank of India CRAR equals to around 4,500 to 4,600 crores. So we will be having a 2% increase, 2.0% increase in the CRAR by FY26. And 1% shave off should come because of the ECL.
Have you also counted because of Basel III norms?
And I do not think much impact will happen on the CRAR or the profitability of the bank.
Fair enough. Okay, I'll discuss about the Basel III on another occasion since we're running out of time. I wanted to just get one point in. Did the government get in touch with you about consolidation at all? The buzz keeps coming every now and then. Can you enlighten us?
No, we have no idea about that. It's a government's prerogative and there is no consultation on that.
Okay, and you're not raising any capital?
No, not at present. In this financial year, let me clarify, from the board, we have taken approval for raising our CET1 and CET2 for around 5,000 crore in FY26. CET2, we may be coming, Tier 2, we may be coming in this quarter, in Q3 quarter. And as far as the equity is concerned, there is no plan as on date for raising any equity this financial year.
Okay, well, we are actually out of time. We will invite you yet again for a more detailed conversation. It's just such a bunch of earnings that came over the weekend that we have to keep things short. Thank you very much, Mr. Karnataka, for joining us. And once again, season's greetings to everyone at Bank of India.
Thank you, madam. Thank you, Lataji, and to the entire team of CNBC-TV18. Thank you.
Okay, thank you, sir. I just want to say that, the market has ushered in Diwali Day with a lot of gusto. Just as we were, at 10 a.m., it looked like the market was giving away some of its gains. The gain on the Nifty dropped to about 100, 110 points, but it's charged up once again. And I am not surprised who is leading it. It is the banks. Almost every banking stock that has announced numbers has surprised on the upside in terms of margins, surprised on the upside in terms of credit growth, and the regulator has been, getting kinder and kinder to the banks. So my sense is that the Bank Nifty, which is already at an all-time high, is likely to push the Nifty to fresh all-time highs very soon. We wrap up on Bazaar on that cheerful note. Chartbusters coming up with another bunch of earnings interviews.